Would you feel discomforted? Would you feel challenged? Would you be really curious about who the person is? And to the extent, if things go wrong, maybe you will end up chasing him or her and kind of get into an altercation debate, and maybe the worst case, maybe a kind of fight, right? Now, just imagine a situation you are getting into an airport hall where everybody is a stranger. Nobody knows you. Everyone looks very different, behaves very different. Everyone is different, right? They're not like you. But yet you don't feel threatened. You don't feel challenged. You didn't have that uneasy factor that you had when someone as a stranger walked into your premises. Why is that? If you really look at it, you might explain it, well, it is, it's by convention, because you're not threatened when everybody is in an airport. They're all flying for a common purpose, nobody is threatened, and so on. At another level, you will feel that, somewhere it is embedded, it is assumed, it is embedded in the system that, yes, you are in a safe space called the airport, where no one would harm each other, no one would, this thing each other. So today, as we are exploring and now even to ideation phase, we are coming out with a bunch of ideas, and the fundamental building block, the enabler, as we say it, is technologies, digital technologies, to say the least. Now, the point is, if you look at several of these technologies are sources of, some of them are, you are skeptic about that information, the likes of fake news, the motivated news, the WhatsApp university, and so on. Then we mistrust the tech giants, right? What they would do with so much of our data and, the algorithms which can potentially change our lives. Then we have the fears of surveillance, because everything is being watched, everything is being known. And then cyber crimes and so on and so forth. The list is long. So there is an element of digital mistrust. Now, how do we build the essence of trust? It's kind of embedded. The best way to do it, as they said, you can create trust by eliminating the need for it. For example, trust is created in the airport hall by eliminating the need for it. There was no need, right? So therefore, drawing that metaphor, drawing that analogy, you will see how today the subject that we are introducing to you is how can you build ideas on a bedrock of trust. Blockchain is just one of them. Of course, it's the most significant technology that's being talked about, blockchain 101. And for that, I have none else than Trent Willer. Trent, I'm sure many of you know the sprinters who are a part of the sprint team. No, Trent is one of our dear coaches. Now, Trent's introduction doesn't end there. It kind of starts there, but he has a long list of introduction. Now, to make sure that I don't take much time in introducing him, I just want to say that he's an interesting person. He's not just an engineer who has played a big role in the oil and gas industries, but he's a private pilot. He's a yoga trainer. He's the president of Digital Entrepreneurs Association in Australia. He comes all the way from Perth in Australia, and he's going to talk to us. And so far as his role in EXO is concerned, he's a head coach, he's an ambassador, and he's a boardroom advisor, a C-suite advisor, the list goes long. So without further ado, I would like to introduce Trent Willer to take this to you. And as usual, keep your chat window flowing. Zahira will kindly, moderate the discussion and take pauses, look at the chat window and your interesting questions, and Trent would be happy to deal with that. Thank you. Over to you, Trent.
Thank you so much, Saman, for that lovely introduction. I'm very humbled and pleased to be here today to share some of my insights and learnings with you about blockchain. I have got, yes, quite a diverse, let's say, corporate history, even business history. So I've grown both public and private companies, multinational, international companies. Done engineering, a lot of corporate board work, capital, so fundraising on both public markets and private equity and investment banking as well. And one of the companies that I was running a number of years ago that was an energy company with projects in Africa and Australia, we'd done a joint venture in Africa to help community developments that were off-grid and dealt with their own water, and we were dealing with their energy. And that opportunity within that community for the households to be able to trade power peer-to-peer really brought me to blockchain. And then I dived down the rabbit hole. So I've been in blockchain probably now for, it's probably since 2014, 2015. So for some time, and both, within the crypto, but also very much within real use cases of blockchain. So there's a lot of technical detail to blockchain. That's not what I really wanted to get into today. Today, I really wanted to give you an introduction to it and some of the considerations around it and different applications for it. So then you can, have ideas of how it can work for you or possibly work, and some of the considerations you'll need to address. So to start with, I wanted to take you to, an emerging, actually I better share my screen yet. So I'm just realizing I haven't shared that yet. Give me a moment. Share screen 1. There we go. Can everybody see that screen now with the cover title page? Great.
We can.
Thank you. Sorry for not having that up earlier. All right. And you'll come through this theme of trust that Simone's just led to as well. So let's talk about emerging technologies. I want you to imagine for a minute different emerging technologies, but not really where we sit right now. I'd like to take you back a step to circa 1440. And an emerging technology at that time was the printing press. And that's why we refer to Gutenberg moments, and it's something we talk about within EXO quite a bit. Now, why is this important? Well, how did a printing press really have an impact? It enabled the mass production and the spread of printed books. And that's great, terrific. But what are the secondary and tertiary impacts from that? What did that enable? That really meant there was a circulation of information and ideas. There was a transference of knowledge and hence power that came from a hierarchical control over books and the clergy and et cetera, down through to the mass of people. So it really created a significant change. And then that distribution of information and knowledge could be applied in different ways and cause all sorts of other impacts, industrial and otherwise. And it wasn't just there was that one point in it. There was a work up to get to that point of the printing press, and we've had ongoing, innovations and disruptive innovations, some of them through that period as well. And where else does this apply? Something close to home for you. And again, I'm no expert in this process, but, weaving, going back to that same sort of period in the mid 1400s, was a very manual process. And then there was a step change in the 1700s where it came across, utilizing the flying shuttle. And then another big change in those late 1800s where we saw the power loom come in. So it didn't require manual labor as heavily anymore. So then we were able to have, mass-produced textiles of quality and a lower price. So again, how did that change the world? This one machine, this one step change in innovation or integration often of innovation has this knock-on effect in one area, but then across multiple different industries and culture and the whole way we operate. So fabric production has a number of components and processes to it, okay? And you know this better than I do, but just, I wanted to highlight a couple of areas. Really, you've got raw inputs, you've got technology that it utilizes within its processes, and then you've got products and applications that come out of that. And I'll come back to this later when we talk about blockchain. Now, as you've seen in some of our other slides, we really look within EXO at a number of emerging technologies, and there's a growing list of those, and this is just some of them. And one of them that we'll talk about today is blockchain. Now, the other reason why this is important, and I'll tie it back to the 6Ds, where we're really talking about not only is blockchain tied in with the digitization processes, that's really fundamental to start enabling it. It's these later stages where we come into we see the disruption of blockchain coming in and impacting industries, but it's really where we're seeing the adoption around demonetization, dematerialization, and democratization. Those 3 Ds are really what blockchain in its fundamental DNA can enable. And that's why we're seeing such rapid adoption and really amazing things get done and tested with it. along with failures, there's learnings along the way. So coming back to those components in your textile production, for example, blockchain is really a technology and process. Don't confuse it with a product or application. Products and applications are getting built using blockchain, but it's really just enabling them. Okay, so we'll come to this again as we revisit some of those products and applications, because really what I want to highlight is that blockchain is not Bitcoin. Bitcoin is an application of blockchain as a technology and process. So everybody who knows about Bitcoin and cryptocurrencies, there's some amazing ones. There's some that are a bit dodgy. People trying all different things, but cryptocurrencies and Bitcoin are an application or a use case of blockchain. Blockchain technology is the underlying, technology that enables those to be built as applications on top of it. So what is blockchain then? Well, it's a long, but it's a fairly concise definition. It's a consensus-based, encrypted, decentralized database which stores information immutably over a peer-to-peer network. Now, what does that mean? I'll try and work through an example that might relate it back to something we do all the time. So, has anybody ever received some income? Has anybody ever gone and bought something, right? We love that the kids' piggy bank idea, whereas they save money and put it in their piggy bank and then they go and buy things and they're keeping track of what their savings are in there. So, there's credits that go in there and there's debits when they take money out for expenses. Now, if we're doing this in accounting, for the company or your business unit or your production, we keep it an accounts ledger. So we do this digitally nowadays. You've got your accounts. Again, in the accounting world, double entry, ledger of credits and debits was a game changer in the way they manage their accounts, where you've got credits that come in and debits that go out. And you keep this ledger. So anytime you had money come in, you'd write that up as a credit. And when expenses went out, you'd write that as a debit. So if, for example, I said, Trident, I want to buy $1 million of toweling. I'm good for it. I've got $10 million. We do a transaction here and you'd probably want to look at my ledger or my bank account and the ledger in my bank account and go, does he have $1 million to pay me for that $1 million of towel? And so this would be the record keeping of that account, whether I do or not. Now, in blockchain, it's not, so blockchain is like a database. The accounts ledger is like a database where you're keeping track of everything that goes in and out of it. So the blockchain is like that. We could just write financial data to it, but we're not just writing it as in, I've got $1 million in there and Fred's taken $200 and Anne has another $100. It gets encrypted. So the information that gets put into that database, into that ledger, is encrypted with a security key and cryptography. So that information, whatever that string of text is, for example, gets encrypted so it can't be read by anybody else. Now, it's then also distributed. So not only is that one ledger, that one accounts book held by me, for example, and my bank, Saman might have a copy and my team might have a copy, and there might be a copy in the US and Africa and all around the world. So there's copies of that one book all around the world. Everybody's got a copy of it. If I go and put another $1 into my ledger updates all those other copies all around the world. And they validate, yes, Trent's got another dollar come in, and that gets recorded in all of those ledgers. And every transaction that happens gets distributed to all of those transactions, and they all cross-check each other and make sure that that's valid. So that's the distribution. So that one ledger is represented, is copied and held all around the world. Now, when you're writing up this ledger book and putting transactions in it, at the end of the day, you've filled up all the pages with all the things you've bought and sold, for example. And when you've then finished that book, you're then going to need a new book, a new ledger. So let's call that first book block number 1. So as you filled in the ledger and put all those details in there, and that's been copied all around the world all the time, book number 1 closes, book number 2 is started. The 2 of them are linked with some special information, and book number 1 all around the world is closed. It's not able to be changed, it's locked, and everybody starts on book number 2. And everybody starts writing to book number 2, all the transactions. And of course, this isn't just my book. This is a book that everybody else's transactions go into that are putting entries into the blockchain. And everything is validated. And then as that book fills, that gets locked and it's linked to the next book. So that's essentially what happens where we've got, just like we've got accounts, ledgers or databases with information going in. And then when they finish that, they start a new one. They link it and say, here's book 1, book 2, book 3 of 3, book 4 of 4, etc. That just simply gets copied all around the world. So it's distributed and it's decentralized. And that has advantages from a security point of view, a safety point of view, a speed of access point of view, etc. Now, the important bit to this too is if a transaction happens and you want to check that I've actually got $1 million in my account, I go, yep, here's my general ledger, have a look. I've got $10 million, so I can buy that $1 million of towels. No worries at all. Try to go, I'm going to check the system. I'm going to go and poll everybody and see what the vote is. Does Trent have $1 million? Oh no, he's only got $10. All the other ledgers around the world say he's only got $10. So Trent might have fiddled his particular book, his ledger. And we don't believe that. The majority votes and says that's not true. So by having a vote and trusting all the system, that majority rules what is valid and what is not. So it's not back to just trusting one person or one data set or one database or one intermediary, and you're trusting the whole system. So because this is based on software, because there's algorithms that are locked in place and they're immutable or can't be changed, that's where the trust is built in. But we don't have to trust anybody in the whole system because we can trust the system. And because that's set in place and it's transparent, everybody can see how that system's been built. If somebody's messing with it or something's wrong with it, it can be highlighted and dealt with. And everybody's able to see what's going on there. So by trusting nobody, but trusting the system, we can trust what's in there. Now, there's some complexities in that too. And it's not as though it's just been a new thing that's popped up on the radar. It's been around for some time. So, in 2009, Satoshi Nakamoto, an anonymous author, really wrote the paper, the white paper, a Bitcoin, a peer-to-peer electronic cash system. And that's what started Bitcoin. And the reason it was designed in a particular way, so that it's got a limited production, so that it deals with inflation issues, that to counter government, for example, government fiat currency. So there was a philosophy to why Bitcoin was designed the way it was. But that aside, it was essentially an integration. We already had digital currencies. We've got distributed ledgers. We've got cryptography was already in place. Open source was in place. We had gamification, and that's become a bigger thing, but that's part of what we do as well within, these blockchain systems to enable the engagement and the whole system become self-sustaining. And we also had peer-to-peer networks, which is a way to distribute those networks or decentralized networks. So we had a lot of these existing technologies, but really Satoshi brought them together in this proposal in that white paper. And I'd even go back further. I know Scott Stornetta, and he actually wrote a paper back in 1991. So we're talking, 20 years or 30 years ago now. That was really some of the fundamental basis that was actually referred to by Satoshi in how to timestamp a digital document. So it's that unique identification that was important. So again, I want to highlight, even as you're looking at opportunities moving forward, it's not about one emerging technology that necessarily makes a difference. It's the integration of technologies that often makes that step change possible. I won't go into this slide. There's a lot of detail there, and this can be provided later. But essentially, it's that idea that blockchain is this link of blocks of data that are copied and held all around the world and then polled by the system. And trusting the system is what enables you to trust the information in there. The other, two things I should point out here that's interesting is the data that we put into that blockchain is encrypted, so nobody else can read it. Now, the trick here was, if you can't read it, if no one else can access it, how can they check that Trent's got $10 or $10 million? Well, by asking from the mathematic algorithms in there, by asking a question and putting into that algorithm, it's got a special key system. So it basically goes through a process that it doesn't read what's there. It's just checking that what you're saying can only be valid if you actually know that that's the case. So it's actually doing like this trust check in the system. So they call it the Byzantine generals problem, and it solved that problem. And that's how it can check something and see if it's valid without actually seeing the data itself and knowing what that information is. So it doesn't know whether I've got $10 million or $10. It's just checking, does Trent have $1 million to be able to spend, and validating that. The other thing this solves then is that double spending problem. And that's where on the internet, for example, for online sales, how can you tell if there's a transaction done on the internet? How can you tell if I've done that sale once and deducted $1 million once, or 100 times, or 1,000,000 times? So that's where it solved that, because it's got that unique traceability too. All right. So some of the key reasons why would we use blockchain? It's immutable. So, fancy word, but essentially means that it can't be changed. Once it's there and locked in, it can't be changed. It's there for history, and anybody can go back and validate that. It's trusted, and it's strange because it's trusted because we don't trust anybody in the system. We trust the majority in the voting system. It's secure because it's encrypted. It's not necessarily anonymous. Okay, so be wary of that. People think it is, but it's not really. It's hard, but it's not necessarily anonymous. It is programmable, or can be programmable if you want, because, well, I'll come to that later. It's decentralized. Now, that can be helpful from a security point of view, where it's not just held in one location or one country, and it enables cross-border movements very readily. But it's also wonderful because it now means that we can create community-driven, blockchains, applications, systems that are driven by a decentralized community, and the whole community votes on the system and how it works and who's going to use it, and everybody can access it, rather than it being very controlled. You can also do private ones, which we'll come to too. So the last point, and something you'll hear a lot of talk about at the moment, is fungible. Again, another fancy word, but really it's whether it's fungible or non-fungible. So we'll come to that, but it's really whether this is a unique thing or whether it's common. They're all the same, or they're all unique and different. But the critical thing that I really love about blockchain, and what it really comes back to, is, yes, it's a medium of exchange. Yes, it's the data, and it provides provenance or traceability. But all of that comes back to, it enables an exchange of value in whatever form that is. It can be monetary or otherwise, because of the trust that's inherent in the system. And because that's transparent and traceable, it's so much more trustable than a whole lot of those other systems out there where it's intermediaries or governments that you need to trust. So it's really a store and exchange of value because you can trust it. Now, how far out is your blockchain? Okay, there's all different blockchains, all different protocols, all different applications. So this is why it's sometimes really hard to understand what is blockchain, and we don't want to throw the baby out with the bathwater. Just because that one's a problem and that one won't work doesn't mean there's not something that works for you. I love the diagram I've got here on the left, and this is for so many different applications. I use it where, you can do incremental innovation. You can really step out where you're into new areas, blue oceans and new markets and offerings and products, and that's where you're getting revolutionary. Or there's evolutionary in between. So there's all those levels of blockchain depending on what you need. Now, you add in the more revolutionary ones are typically those public blockchains. So that's where everybody, out in the public can access it. And it's a very broad community, and it's trusted by that whole community managing it. Coming back to the other end of the spectrum, you can have a private blockchain, which is just where, for example, your own company might have it, and it's your blockchain. People can come and use it within your system, and that's it. It still might be decentralized or distributed, but essentially your private blockchain you're managing. And then you can have federated ones, which might be a consortium that come together and that group can access it and manage it or govern it rather than it being a public governance. So there's different levels for how you can implement that. We'll go back to another analogy, the telegraph system. So, why was that disruption really important? In a way, we transitioned from an analog signal to a digital signal. Morse code was digital. So we were starting to do digital. It's just on an analog transmission line still. And it was important too, because we needed transport infrastructure. And both of those are important for blockchain. What sort of characteristics did the communication have? Because again, that communication is what opened up countries and the world to be able to communicate and do things and business and live in a different way. So, again, it was distributed. It was timely. It was much more timely than mail or shipping things. It was fairly reliable, and often, it was more reliable in places than other modes of transport of communication. And it was trusted. But the question there is, why was it trusted? Well, it's because it was a telegraph service. They were trusted operators and communicating your message securely, and you could trust them because they were, a trusted service. So that then leads into other areas too when we look at governments and currency, etc. Now, the other one around communication but not trust is the internet. So again, we saw the internet boom, and that was another level of disruption in communication. It was rapid, it was data rich, and it was global and real time. Okay, so much more color and value than telegraph, for example, or even telephone. But it doesn't have the trust. That was an inherent problem that wasn't built into the whole fundamental DNA of the internet. You couldn't trust. There was this double spend issue. You couldn't tell if something happened once, if it was a copy or not on the internet. If I build a web page and put a document on there, is that the one and only copy of it, or has someone tampered it or copied the whole web page or copied a transaction, etc.? Now, where else does this come into? What is trust even important? When we have communication, is trust even important? So we can have high communication, great real-time, high bandwidth, but it's useless unless you can trust it. Tesla, I think, is a great example. You've got vehicles that are driving and self-driving with, real-time IoT and automation and map guidance, etc. So strong in communication, but would you trust it? What lets you trust it as a system? Because that's really important when you're putting your life on the line and switching to automatic mode. As I talked about, trust for online sales is a really important thing. And this is probably something that really will play out with Trident, with your systems. So how do you build that trust, not in your brand and your products, but in that transaction? Typically, we do it by a third-party intermediary. That might be a payment gateway. It might be a bank. And the same's the case for supply chain logistics, etc. We have an intermediary to go and validate its quality, to inspect it, to hold money in trust, right? So when we're doing a transaction between two parties, so often we'll put a third party, an intermediary, or multiple in place so that we can trust them. So it removes that counterparty risk within the two parties doing the exchange and potential conflict of interest, but we still have counterparty.
Trent, we lost you. We can't hear you, Trent.
I guess his image is frozen.
I'll just text him. Meanwhile, the rest of you, how's it going so far? Any questions?
Oh, his computer is rebooting.
It's rebooting, is it?
Yeah.
Okay. Yeah. All right. We'll just get a sense of how's it going for our audience. I've noted the question on block tree. We'll pick that up with Trent. Informative, yeah, okay. Are you able to relate to what Trent is saying? He's tried to simplify it first. Blockchain as a concept is difficult to address, but he's trying to make it easy for our level of understanding. Okay. That's good. Can anyone think of use cases at Trident for blockchain? Basis what you've heard.
Hello, Mohit Poddar here.
Yes, Mohit.
Yeah, for traceability of our raw material, it can be used. Blockchain can be used. Then in the supply chain, even the finished goods dispatched to the customer can also be tracked so that they can come to know in real time what is happening and where are their goods. So I will say overall the supply chain, blockchain can be very convincing technology.
Mm.
Yeah.
Very well. Good on you. Yes, like end-to-end tracking, material tracking. So pretty much Yala's saying the same thing. E-bill of landing. Good. Has Trent joined back? Trent, you're on mute. Unmute yourself. Yeah.
I have. So sorry, everybody. Apologies. Okay. My computer decided to freeze on me. I do apologize. Doesn't happen often, so I'm sorry. All right, can you see my screen again?
That's okay, Trent. We took time to pause, and I was asking them about use cases of technology, and you know, they have some examples of SCM lading. So
Great,
yeah.
that's where we're going next. Excellent. Yeah. All right. So
Continue.
That intermediary, you know, function is something that blockchain can displace from both a counterparty risk and a timeliness and a fee point of view as well. So that's been a big driver in supply chain, finance solutions, documentation, etc. Okay, so really, blockchain is a trust machine, if we think about it that way. And then what can you if you have that trust fundamental in your system, what can you do differently? Where can you eliminate those intermediaries or risks? This is some detail in terms of that encryption, but I won't go into that. I will make a quick comment that blockchain versus the internet was very sort of shallow on protocol, and then applications were built on top of it. Blockchain's different. We're seeing very intense protocol layers get built, and hence a lot of experimentation, and it's shaking down which systems. So there's a lot of validation happening at the moment, and we're seeing interoperability stuff get built as well. But we're seeing a lot of applications get built on top. But there's a lot of capability within the protocol itself. And that decision and watching these different protocols get built for different purposes and get validated in different ways is really important. And, you know, just like in your paper, for example, you know, you've got different standards, different protocols that you need to deal with. And another analogy would be going back to videotapes.
Could we just go to the previous slide, the one prior to this?
This one?
The one prior to this. Yeah. Is this the one you want, Sanjeev?
Yeah.
Okay. Any
Great.
question?
Okay, I can describe this very briefly if you'd like.
Yeah, please.
Okay, so I'll describe the right-hand side first. This is just an example that for a particular input, we put it through a cryptographic hash function, which ends up creating a hash string, which represents that word. This function, this encryption function, can't be gone backwards. But with a key, you can validate that this is the case and match. So only the person with a key that has done this hash function can work backwards from this hash back to what the input was and validate it. And if you, like the engines for these different hash functions, you can understand if you make changes to the particular input, it will create different hash functions. And so you can take this one and hash it, and then modify the input and rehash it, and you'll end up with a different hash that's linked back to the original one. So you can get this chain, this daisy chain, that can be validated backwards and see that history, but no one else can look into it other than the person with the key. So on the left is really how, in terms of blockchain transaction, you've got two parties that come along. They need to have their own identity, their own key, that is their identity or key into that blockchain protocol. They then do a transaction using the application as an interface to the blockchain, and whatever they've done together then gets written to the blockchain. So it's encrypted and hashed and written to the blockchain and locked in place on the blockchain. And the blockchain has everybody else's transactions going on. So there's all the other things that happen that get written on top of that, and they're all interlinked. And nobody can, they can see that hash, this string, like on the right-hand side, they can see that hash, but they can't see the inputs. And then later on, somebody might, those two parties might come back again and come back and, sorry, they've done the deal, transactions done. They might actually come back later and do another transaction. And that could then come back with, because they've got the keys, and interact with the original transaction and go, yes, we had that here. We'll now change this and revise it. And this is a new outcome, and that gets hashed in place. So the key bit here is, pardon the pun, the key. You need to have the key to enable your cryptographic hash function within the blockchain, and then it gets stored away. So there's a lot of responsibility in the blockchain. If you lose your key, you cannot go and deal with whatever's been hashed or encrypted in there. If we're talking cryptocurrencies, then, for example, you need to store that in a wallet that stores your cryptocurrency and have a key to access it. And that wallet is really just an address in the blockchain that tells the blockchain you've got X money stored there in that address, and only your key can access that. And so if you lose your key to your wallet, you can't access those funds in there, for example. Or if that's transactional data and you lose your key to your cryptographic function, you can't access that data in it. So there is a lot of responsibility in there as well. Does that help describe that slide a little bit?
Yeah, thank you.
So we're seeing a lot of protocols. So just like we saw a battle of protocols for video, for example, where some might be more convenient, some might be technically better quality-wise, we're seeing that with all these different blockchain protocols getting stood up, whether you're talking Bitcoin in a cryptocurrency, Ethereum as a protocol, Cardano, there's all these different ones that are getting stood up as operational protocols, and there's ones that are being stood up as application protocols or tokens to incentivize communities, etc. So because it can be applied in so many different ways, it can be very confusing. So again, blockchain is the technology that can be applied in all different ways as both, a product or a service, really. Okay, so there's lots of challenges around blockchain. A lot of those benefits, its immutability, its distribution, its encryption, etc., they can actually be challenges as well. And then you've got a lot of issues around the integration into your existing ecosystems, be that regulatory, financial, etc. So one way to think about blockchain is it's an expensive database. Do you really need it? You really need to have a good driver to be implementing blockchain. There's a lot of hype around it. We are coming off the back end of the hype cycle a little bit more. And so we are seeing adoption by large companies. They realize they need to adopt it. It's impacting them in certain areas. It's a matter of how. And remember from this chart, I think you might have seen earlier, when these adoptions kick off, when they come into effect, it happens very quickly. So we're really going to see this over the next number of years quite rapidly now that we've got sort of a critical mass of adoption. It's that exponential curve kicking in. And again, it's a value comes from an integration. You tied in with IoT, you tied in with AI, you tied in with a sharing economy. It becomes really, really powerful. An example of some of those impacts we're seeing then is it eliminates the need for intermediaries. We can have automated smart contract processes. You've got that transparency and provenance that you haven't been able to have before without trusting some person. And it's global. It's 24/7. It's borderless. So some of the use cases, I like this one because it breaks down into a couple of simple groups. You've got, what you're seeing in terms of digital currencies and all the different applications of different digital currencies. Obviously, this provenance, this traceability and auditability helps in record keeping. So you can see it being applied in all different areas around record keeping, medical and property titles, etc. It's, just like currencies, it then applies to security. So we're seeing it applied in terms of alternative and conventional equities and securities and derivatives and trading markets as well. And then the smart contracts, and I'll come to what they are, but essentially the ability to have automated processes and transactions that happen automatically within the blockchain, hands off, is really something that's very powerful to enable scale and trust within the system. This is another slide that I really like that shows some of those use cases in a bit more detail. And I've zoomed in on some of these.
A question for you.
Yes.
May I just come in with a question?
Please.
So Vikas is asking us, why is it blockchain and not block tree?
Because there's no hierarchy to it. It's not as though it's the first block and then blocks built on that and then more blocks and more blocks, or flipping the other way. You don't start with one and then there's 2 and 3 and growing that way. There's one block and then it's copied around the world and distributed. Okay, so there's a network of that one block. And then those nodes, or miners, as they call them, those nodes then work on the next block and the next block and the next block. So each of those nodes just keeps collecting block upon block. So they hold the blockchain, which gets up to, well, it just keeps building. So, I forget what Bitcoin is at the moment, but let's call it a couple of thousand blocks. And then they mine the next block and the next block. So that happens around this distributed network. So it's not a hierarchical distribution. It's a entangled, autonomous, decentralized network.
Got that. Vikas, is that clear? Yeah, let's proceed.
So I won't go into too much detail on these use cases. You can look at these, in other areas or off this presentation later. I'll talk through a couple of different ones that are applying it. So in banking, for example, because you've got traditional banking where, again, if I want to do a transaction, I go to my bank and I'm sending it to a bank in another country, all these intermediary correspondent banks need to process it along the chain. They take their fees, they take time, things can go missing, etc. So how do you speed that up? How do you have automation and traceability to it? So Bitcoin is one way, and that's where they bypass the banking system essentially. And then Ripple is essentially a bank now controlled system that has been a system they've put in place instead of the SWIFT system as much to enable that. So they're adopting it. Bitcoin as a cryptocurrency is a great example of it because you've got miners that work. So it's basically a cloud-based currency that's built on a particular software system that is open source and been agreed. The rules can't change unless everybody votes to change any rules. Everybody can see what the rules are. And you've got nodes that manage the system for everybody and get a fee for managing it. You've got the exchanges that trade everything back to fiat currency and back into these cryptocurrencies. And then any user can have their own software wallet or a hardware wallet, and they can do transactions using that wallet. They can store on that wallet. They can even, you don't even have to store on hardware. You can remember the address for that with 12 words. If you remember 12 words, you can reseed that wallet. So you could travel around the world just memorizing 12 words and be able to stand up an account in any country in the world that holds millions of dollars. So the transportability of it and security of it is really strong, but you're very empowered. You're very responsible to manage that then. Nobody else can get in there to help you, unlike a bank. Energy trading is another wonderful example, and that's sort of where I came to it, was that opportunity for peer-to-peer trading. So if—
Sorry, Trent, we lost you on the last two lines.
Sorry, can you hear me now? Can you hear me?
So you got muted by mistake. You got muted by mistake. Could you just repeat the last three sentences?
Sure. I think I was saying that you don't even have to store this on a software wallet or a hardware wallet. You can take it back to a seed, which is a key for you to it will reseed your wallet. So you could have, let's say, $1 million in a wallet. And if you remember the 12 words that can reseed that wallet, you could travel anywhere in the world and just re-stand up that wallet and access to your $1 million without needing to carry anything with you or take anything anywhere. So it's very secure. It gives you a lot of empowerment and mobility, but nobody else can get in there for you. Unlike a bank, if you forget those keys, you can't get that money back. So it's very, responsible.
So question here.
Yes.
Why are few governments not regulating Bitcoins or cryptocurrencies?
Various reasons for that. Personal opinions. They were behind the 8 ball and they didn't understand it. 2, they've got incumbent legacy vested interests. And 3, they can't control it. It was growing up around them. It got away from them and it's living and surviving without them. I think it needed regulation and adoption by the countries. The sooner the better, because that will enable a whole lot of it to happen. They are trying to now deploy their own nationalistic blockchain-enabled digital currencies because they've had digital currencies for a long time, but they haven't had that blockchain-enabled digital currency. They are trying to control it with the onboarding and offboarding of fiat currency. They really just want to be able to have insight to it and manage the tax implications. And look, it's not. Nobody should be using these systems in the wrong purposes, but it gives them a whole lot more power and transparency and autonomy that a lot of the other systems don't have, for dumb reasons. So the government's trying to play catch up and trying to control it. And again, because it's global and not impacted by just one jurisdiction, it's very complex for a particular country to address. But also as a blockchain developer, it's very hard to implement a global solution that can be implemented and address every regulatory jurisdiction issue as well. So they're trying to play catch up and do it their way.
Okay. I'm interested in knowing your answer on this one. Can crypto replace flat currency in future?
That's fiat currency. Yes, I think so. Which protocol that will be is to be seen. How it plays out will be very painful. And it will be a fight to the death, I think, by the governments and the countries trying to retain control of their own national currencies. And I think we'll see whether the likes of the IMF, repurpose the SDRs and it's a push for a global, one world currency. Yet to play out. So really the power is with the people. If they manage the adoption and keep building and drive it, it's up to them if they want to have a global community controlled currency.
Right. A leading question, does Bitcoin carry value just like the fiat currency, or its price is all about demand and supply?
Both, and trust is another key thing. So I guess Bitcoin differs significantly from a fiat currency. A fiat currency, we can have a discussion about money and currency because the things that you run around with thinking is money in terms of paper or plastic, that's fiat currency. Never mind what's digital currencies and ones and zeros on your screen. They're not actually money, they're currency, and that's different from money. Money's got to be a store of value amongst other things, whereas currency is not necessarily a store of value. Bitcoin was designed to be a store of value. So currency, the problem there is the government, like they're doing at the moment, the US government, for example, can go, right, we're going to print another X trillion dollars, and that can have inflationary pressures or other destabilizing or negative detriments for, let's say, all consumers. So Bitcoin was designed to say, look, here's a system. This is how it's being designed and built. There will only ever be 21 million Bitcoin ever produced. It is done in this profile, and that's it. So just like gold is meant to be a store of value because it's a scarce resource and not able to be generated by governments or anybody else, Bitcoin was built as a system that was a scarce resource that was controlled and known, so that it's not able to be manipulated or inflation created, etc., by governments. So that's why Bitcoin as a protocol was designed that way. Bitcoin has flaws in the energy and the proof of work system, etc. There's other systems that are addressing that. Which protocol will win is to be seen. Some have got issues with speed, some are much faster, etc. So there's challenges around the protocol that's getting built, but can a blockchain-enabled digital currency replace fiat currency? Yes, I believe so. And there's a lot of advantages to doing that. Will it be a painful path for governments and communities? Yes, it could be.
Thank you. Let's move on.
Okay. And it's a very volatile space at the moment. Okay, Provenance Diamonds, for example, is a great use case where it's been really adopted there and helping bring provenance back to source. And this is really important as you're looking, for example, as you're looking at users that want to look at sustainability and ethical sourcing, where it came from. And then also, if you've got that traceability back to source, when you're looking to do circular economy work, other users can look back, where did this product that I'm now recycling come from? And they can see it all the way back to source. So you can help close that loop with this type of traceability. I've done a lot in the value chain in minerals and metals and specialty products. On-demand manufacturing, again, this is where blockchain can link in with that, so that as you've got portals and platforms that enable on-demand manufacturing, personalized production runs, that you've got that traceability through it and the integration of all the attributes, and you've got self-auditing of it, but then you can also tie in cryptocurrency if you wanted to. Another thing we talk about in EXO is looking for where there's the abundance. So for example, where you've got, this company Filecoin identified that there's all these hard drives sitting around or processing power. Other companies do it with processing power sitting around that is sitting idle. So why not create a protocol that could make use of your hard drive or your processor power while you're not using it, and they'll give you tokens for it. They'll give you cryptocurrency for people that use it. So somebody can use it, they pay cryptocurrency, you get the cryptocurrency. So it comes back to the trust and the faith. So just as coming back to the other question, if I hold up a $50 note issued by my government, I'm only going to go and give it to somebody and exchange value or hold a $50 note if I think it's going to be out, someone will exchange it for $50 in the future. If I don't believe that, if I think it's going to be worth less, then I'm going to get rid of it and not want to use it. Same with cryptocurrencies. As long as there's a community user base that uses it and believes in it, it can grow and be adopted and be useful. So that trust is really critical. AI.
What are the risks associated? Trent, if I may just come in.
Yes.
A question. What are the risks associated with Bitcoin?
It depends how you're using it. Are you going to be using it as an alternative investment asset? Are you using it as a store of value? Are you using it as a day trader and investment portfolio? Are you using it for payment systems? If you're using it for payment systems, it's a slow protocol, and there's other systems that are quicker and faster if you want to do trades with it. As a store of value, it's probably more trusted and reputable and got a critical mass and major buyers into it now of the established financial system versus a whole lot of the other smaller ones that are still growing. So as a store of value, it's probably a more a less risky blockchain to be investing in or storing value in than some of the others. But it depends how you want to use it. Issues with it would be, can you, are governments going to block in regions? If you need to get fiat currency back out, can you on-ramp and off-ramp out of the cryptocurrency system into a fiat currency system? Who's going to do that? Will governments shut that down and not allow banks to do it? That's a risk down the track. So yes, and the volatility is a big risk depending on what you're doing too.
Great answer. Thank you. Let's move on.
It's a big discussion. But, look, I entered the market when Bitcoin was around $1,000, and we've seen it hitting up to, 50, 60,000 and a lot of volatility, so it depends what your perspective and time horizon is and what you're using it for. Blockchain is enabling self-sovereignty. So those that don't have passports and identification can have a system that they get sovereign identification on that they then can use in a system. When they don't have a banking system or access to banks, You know, M-Pesa has been there for some time in Africa now, and they enabled smartphone banking by the unbanked, which has been, you know, just grown rapidly. Big data can be utilized as well. So like hard drives and processing power, you know, it can be utilized, you know, for microfinancing and different insights, again, integrating with AI. The big boys are climbing in. Goldman Sachs, JP Morgan, you know, the government's really, the government's implemented FedNow in the US, which is really a blockchain enabled digital currency getting issued by their postal system. So there's lots of really interesting stuff happening. Blockchain, you can't put the genie back in the bottle. It's just how it gets used. Funding, again, I've been around capital markets, both venture capital, private equity, investment banking, public markets. There's a whole lot of alternate systems where you now don't need to have the intermediaries and brokers with black books controlling or market makers the same way, and you can raise funds or exchange funds in different ways. New York Stock Exchange is doing it. The Australian Stock Exchange was one of the first ones to implement a distributed ledger technology. Smart contracts. Smart contracts are really where instead of just putting data in there, such as a transaction of currency, we could say, we're not going to put a text string in there. We're going to put a bit of code in there. So this code will say, you know what, Saman thinks it's going to be 40 degrees next week, and I'm saying it's going to be 20 degrees. And we're going to put a wager on it of $5. And we're going to use the international weather system that it will judge and tell us the weather next Monday, and we'll see who's right, who's closest. And that piece of software will deduct our money from our bank accounts, go and check that system, go and check the oracle of that source of information, and then execute that piece of code accordingly. So you can set up logic and software, and smart contracts can be self-executing. So it's a matter of then tying your legals to it, but systems can be built that are very automated and very smart. So we're really going to see white-collar accountants get hit, auditors, lawyers, etc. There's going to be big impacts in terms of a lot of that work they do. The other topic that's hot at the moment is NFTs, non-fungible tokens. So Bitcoin was created, for example, as a currency, that every Bitcoin is the same as every other one. So there's 21 million Bitcoins to be produced. That's all there ever be. And one Bitcoin is the same as any other one. A non-fungible token, like a Bitcoin is a token, is unique. So every single one of these tokens is unique. So you could say, for example, like this picture here, one ring is different to another ring is different to another ring. They might be similar, but they're not the same. So that way I could have, for example, a piece of artwork, and I could have one token of color associated with this piece of artwork, and another piece with this artwork, and another piece with this car, another piece with this boat. And I could trade those, and anybody would know that that particular token is tied to a particular asset and it can't be swapped out. So it's a way to have a unique token that can be traded and tracked in the system. So that allows that unique provenance piece. We're almost there. Two more things. dApps. dApps are distributed applications. So just like we can build smart contracts, we can build decentralized applications that make use of the blockchain or sit on the blockchain. So this is a piece of software that gets built that isn't just for me to control, and I'm not the one that writes the code. The community writes the code. Those within the rights to govern it build that dApp, and everybody can manage it. So really, Bitcoin was one of the first dApps. Okay. Finally, distributed autonomous organizations. So the fact that we could write a dApp that has some people allowed to govern it, it has a community of users that can use it, it's got a pre-described way of how it's going to operate, and a control means to govern and change that coding, really means that we could have we don't need to have a company the way companies are built anymore. We don't need to trust a chairman and a board to manage a company for the sake of the shareholders or investors. Those investors and shareholders who come into a distributed autonomous company, and the rules, the constitution are set within the software, and those shareholders have got rights to vote and change that. And then all the other users and operators work within that distributed autonomous organization. And that could go on for a long time, just like a normal company, or it could pop up for a particular project. So it's going to be really interesting to see how this blockchain can be utilized to digitize some of those governance and corporate structures that we're so used to.
So Trent, if I may
Yes.
come in, we're sharp 5:30.
Sorry.
How many more slides do you? No, that's good.
I'll leave it there. I'm happy to leave it there. So I guess what I wanted to come back to is it's really important to look at why you need to use blockchain. It is, let's say, an expensive processing database, unless it's really fundamental in your DNA of your solution to utilize particular characteristics of blockchain. If just a database will do what you need, use a database. If the particular characteristics of blockchain are fundamental to your solution, great, put it in. I won't go through these. There are decision trees to look at about whether you really need it or not, what you need to consider, what's important. Those are out there. And yeah, look, blockchain is happening. How it's happening is uncertain, but it's up to you whether you want to adopt it and disrupt with it or really be disrupted by it. I'll leave it at that.
Right. Thank you. So a question that came in from Pratik. Any smart use cases for utilizing blockchain in the e-com space?
Lots. Lots and lots and lots. So it depends what you want to do and how you want to do it. So, but when you come back to those key characteristics around traceability and provenance, cryptocurrency capability, self-auditing, supply chain automation, the traceability within IoT and that, tying back to e-commerce, and getting rid of intermediaries. So when you manufacture something, it comes through that and then goes through your portal for your e-commerce, but then the whole distribution and putting out to that consumer can be integrated as well, and both your financial intermediaries and also your transport intermediaries. So there's a lot of ways it can be applied in e-commerce.
Right. So as printers, have you guys got any ideas for your assignment?
Was that helpful? Did somebody
Anybody
get some
wants to
useful
come off
things
mute?
or ideas out of that?
Anybody wants to come off mute?
Yes, Shashwat here.
Yes, Ashrat.
Yes, so yeah, it was actually. So I've been trying to get into this particular, understand this particular technology for 2 months now, and every time I start to read something, it just blocks my mind. So today, I think Trent actually opened up a plethora of options. I mean, I got a good overview of blockchain, how things work, how trust is actually the fundamental thing for a blockchain initiative. Different areas where we can actually implement that in not only in the current system but in the future. So I've been primarily working in Salesforce technology, and Salesforce is actually working towards bringing up blockchain technologies into the systems. So of course, I mean, good idea, great idea, which actually saved me around a month's time to read books and all on blockchain. So yeah, of course, I'm like thumbs up. Thanks a lot.
You're welcome. It's going to be good when people stop talking about blockchain in a way, because, you know, like when you send an email, you don't go and worry about if it's POP3 or IMAP or the other protocols that underlay that anymore. You just know it happens. You trust that that process and everything in the background happens. And that's where blockchain's starting to get to in some systems.
True that. Yeah. So I guess you've blown Shashwat's mind, and possibly he speaks for a lot of other people on the call today as well. Right. Does anybody have any unanswered questions?
I'm sure there's a few. I'm sorry, it's a very, very deep and very broad area.
So we are, you know, sharp on the clock. If some of you have to leave, you can. If anybody has any questions, please stay back and feel free to raise your questions.
Yes, so I don't know whether it's a question, but I wanted to have a further informative session about specifically on the e-commerce front and also on the Bitcoin front. Of course, those are two different large angled fronts, but these two fronts are like popping on my head as of now. And if there can be a detailed session on these two particular things, of course, it's linked to blockchain. So that would be great. I mean, a much more detailed with good examples coming up, so that it ingrains inside our minds and helps us implement things in real time.
Right. So, Shashwat, maybe you could connect with us offline, and Trent could point you to some reading material, perhaps, if we cannot arrange another masterclass. So,
and we can treat through the sprint address with advisor calls as well.
Yeah.
You know, and not just with myself, there's other experts as well. But sometimes some of those are very, very deep. So I wanted to try and give you a broad overview today.
Right.
Sure.
What's the question? Is consumer ready to pay for this? How to leverage that?
It depends what you mean to pay for it, as in to use this as a system for payment, or to pay for using the system. Because if it's to pay for using the system, there's actually a lot of reduction in fees. So because you don't need to go through the normal financial intermediaries and systems, it's quicker and cheaper. So yes, there's a lot of benefit to the consumer. Are the consumers ready to use it as a payment system? That's happening and growing. So, you know, we're like that hype cycle and the curve, the adoption curve that was next to it. We've got and seen the early adopters. We're seeing the big boys wade in, and it's, you know, as the understanding happens and as it gets implemented in the background of a lot of existing systems, then yes, so it is happening and it's growing rapidly. This last 12 months has been very rapid, or 6 months has been very rapid again.
Right. So,
for example, we saw Tesla, you know, buy I think 1.5 billion of Bitcoin.
Yeah.
And trade it recently.
Yeah. Cool. Okay. So, Trent, I think it's been a useful session, thought-provoking for many of us. And the chat windows indicates that it has kind of triggered thought for many of us on the call. So thank you very much. Useful. And I hope you guys keep that thinking process, you know, tick-tocking through the sprint. Thank you very much. Goodbye, everybody. Thank you, Trent.
Welcome.